Welcome, everybody. Today, we are going to talk about how we decode the market and how we're able to trade with precision by really understanding how to use price action. Now, price action is a topic you'll see talked about a lot online. And it's important to understand that price action is an amazing tool, but we also need to understand what is the context of which we want to use price action. The thing I want you to understand about price action, the analogy I like to use is being great with price action is like knowing how to fly an airplane or knowing how to fly a helicopter. I want you to imagine that you could know how to fly an airplane. So you know how to take it off, you know how to land it, you know how to stall it, you know how to turn it, you know how to do all these various things. So you could fly it up in the air and you'd feel very comfortable flying the airplane around. Now, if I asked you then to take the airplane and fly it from Chicago to Los Angeles, you're never going to be able to fly the airplane from Chicago to Los Angeles, even though you know how to fly. Because you have to know the path. You have to know how to get there. And so when we look at trading, we have all these different indicators that we talk about. And one of the things we talk about is there's only two leading indicators in trading. There's order flow, and order flow is something that people literally spend, banks and prop firms literally spend millions, in some cases, put a B on it and spend $1 billion to get access to order flow. Because like a lot of people think market makers are very smart. I mean, they are smart in some respects, but the biggest edge they have is they have order flow. They see who's buying and they see who's selling. So when we look at the hierarchy of an order, of a trade, the first inkling we have that anything is going to happen is when that order comes into the market. When that order comes into a central order book, you'll see it show up. That's the first time that we have any kind of intention that anybody has an interest in doing things. Once that order shows up in the book, that's called order flow. And now there's all these algos, electronic eyes that then focus on that order to see what's that order's intention. And if it looks like the intention of that order is to buy really big, buy a bunch, well, then they're going to jump in front of it and they're going to buy ahead of it. With the idea that they're going to have to, that order, they're going to have to buy for a long time, or they're going to have to buy a lot, is going to push price up. So if we can buy ahead of it, we can turn around and sell it to them higher later. So they pay big money for this. So we have order flow, which is the intention to do something, but order flow can be gamed. It's a little bit like playing poker where people can bluff. So you'll hear, sometimes you hear a term used, spoofing. Spoofing is when you place orders in the market to create something different, to signal a different intention than what you really mean to do. So a classic example is I'm long and I want to sell. I place a bunch of buy orders in the order book. These algos see the buy orders and they bid the market up, and then I sell it to them and I get out for a profit. That's called spoofing. I'm putting orders in with no intention to buy. I'm putting orders in to influence the market higher so I can sell. That's spoofing. And so that's an example of how, when you look at order flow can be a bit like poker. Somebody's bluffing when they put orders into the market, trying to create demand when in reality they want to sell. But order flow, when it transacts, becomes volume. So order flow is a leading indicator. Volume is a leading indicator. When volume transacts, that is real. There's a record of it. There's a record of a price. There's a record of a quantity. And that will be seen forevermore. So if somebody wants to be buying, there's going to be what's called a footprint. There's going to be a footprint of their transactions, of them buying the market up. That is another leading indicator. So when we see volume, that is something that we can read, that we can jump on, and that we can make decisions. Okay. When that order transacts, that is something that is a leading indicator that we can follow. Now, we talk a lot about the hierarchy of indicators. This is important because this is going to lead us back to price action. Okay. So, in the hierarchy of indicators, when volume transacts, we have a footprint. Now, if we get what we call impactful volume is it's a large amount of volume. So let's say this another way. The market in general will seek fair value and the market will be stable. Fair value will be relatively evident of what it's worth. And so when we have fair value, if the market starts to rally away from fair value, sellers will emerge and sell it because they view it as an edge, and the market will revert back to fair value. And then if the market starts to sell off, buyers will emerge, and they'll buy it, and it'll go back to fair value. So essentially, when the price rises, buyers become less and less interested because they think they're paying too much, and sellers get more and more excited, so they start to sell more and more. So if we have an environment where buyers are they're more and more hesitant to buy, and sellers are more and more excited to sell, the price is going to fall, and it'll revert back to fair value. So the market has this fair value, and it rotates. It spins around fair value. Now, something changes in the market that's going to change fair value. And when this happens, this is called impactful volume. This is a key concept because when we have impactful volume is force. So what happens is when price starts to rise, there's a big buyer that's buying. Remember before, buyers were less and less interested. But now we have a buyer who's very interested in buying. Well, that seller may still show up thinking, oh, this is great. This is a great level to sell. So they sell it, but the buyer is much bigger. So what does the buyer do? Buyer, boom, sticks it up their ass. And immediately the seller, their trade's a loser. And they scramble to cover. Now you have a dynamic where the buyer is still buying and the seller is now covering. And now the market takes off. And when it takes off, fair value now goes on what we call on the move. Fair value gets reappraised. And when we get impactful volume, fair value will travel. It'll migrate. Okay, this is important. And then when this happens, this destabilizes the market. When we destabilize the market, we make it volatile. So volatility emerges when we have impactful volume. And volatility starts to climb. Now, if the market continues to follow through, this creates a momentum wave. And when we get impactful volume, we get a trend, we get a series of momentum waves where buying comes in, buys. They get done, the market kind of recedes back. But then a new wave comes in, buys. They're done buying, the market recedes back. These are the momentum waves. A trend is made up of a series of momentum waves. Well, momentum is a reflection of impactful volume. So there's a whole hierarchy in here. And when we look at indicators such as volatility, momentum, trend, overbought, oversold, they're all lagging. They all respond to the volume itself in the market. Now, these lagging indicators have a place in your trading. A lot of times when people talk about these, they make it seem like, well, they're worthless because they're late. That's not true. They are late, but what these indicators do is they create environments. They give you an environment to tell you how the market is likely to act in that environment, and that environment has value. One of the core things that we talk about is if you want to make money, you need to understand the market environment, and then you trade congruent with it. And if you trade congruent with it, you make money. If you fight it, you lose money. A great example of this right now is in the crypto markets. In the crypto space, we have lots and lots of people that are super, super bullish. They're super bullish, particularly since the election. I have a partner I work with. He's been super bullish on Solana. And when you hear the story of why he's so bullish on Solana, it makes a lot of sense. Okay, so here's this bullish story on Solana. But then when we go look at the market, It doesn't say that. Very early on, we were talking about that Solana looked like it was putting the highs for the year in first. How do we know that? Well, we know that first of all, because we have a market environment that we can analyze. So why are people losing money in crypto? Because they are bullish and they're buying in a down market. Crypto's going down. Crypto is in a downtrend. But the people are bullish. They don't care. They're buying. And what's happening? They're getting clobbered. They're losing a lot of money. And then they're like, I don't understand it. Why is it not going up? Because you're fighting the environment. You're buying against the downtrend. You're buying against the market that has clearly put the high for the year in and has been selling off, and you're fighting it the whole way. What if you had been selling? What if you released your attachment that crypto had to go up and you actually just read the market for what it was and you shorted it? You'd be up a lot of money. A lot of money. So these lagging indicators create the environment. Then within the environment, we use price action. And price action is how we set our trades up. Price action is how we manage what's going on. Price action is how we exit. Now, if I had price action alone, if I'm not aware that we're in a trend, if I'm not aware we're in a downtrend, I'm seeing these little price action patterns that look bullish. I learned this in the class and this looks bullish. So I'll go long here. I'll put my stop here. And bam, you're out. I had my own trade like this last week in Solana. We tried to buy. We immediately were stopped out. Context matters. In trading, context is everything. Nothing is universal. You have to understand what works, where, and why. So price action is unbelievably powerful, but it has to be used in the right context. And if I only understand price action, I am like the pilot who doesn't have GPS. I'm like the pilot that doesn't know how to navigate. I can go up in the air and I can do stalls, I can do barrel rolls, but I have no idea how to get to Los Angeles. So here's an example of what I'm talking about. We do a lot with market profile, and market profile is like the topography on the map. It gives us a sense of what is the optimal path to go someplace. So for example, if you look here, if I want to go from Denver to Reno, and I'm doing this in a smaller airplane, I cannot fly in a straight line there because there's all the mountains in between. So I'm going to have to be able to navigate all of this to get there. Another example is if you fly from New York to London or vice versa, you do not fly in a straight line from New York to London. You fly over the earth. You go over the curvature. It's longer to go straight than it is to go over. But again, we have to understand this. But price action is like basically being able to understand how to fly the airplane. It's like the controls and the instruments. It's like the yokes, the pedals, the throttle, the rudder, etc. All right, once we know this, then we can put this to work. Now that we get this, we learn how to use volume, how to confirm price movement. Now, I'll tell you something. When I first started off in my trading career, I started in this game when I was really young. I was 14 years old. And then when I started at the Board of Trade when I was 17, and I went to night school at DePaul full-time at night. And if that wasn't enough, there was a class on technical analysis that was offered by the Illinois Institute of Technology. So I went and I took classes in technical analysis while I was working at the Board of Trade and while I was going to school for finance. So I learned all of these basic principles, a lot of them that you know about volume and how it works. But then the interesting thing is I applied this over the years, and what I learned about volume, what they taught me in the books, what they taught me in those courses, what I saw in other traders, it didn't work. It worked sometimes, but it didn't work all the time. And there's this whole idea that if we have a rally, if we're rallying, if volume is strong on a rally, that tells us the market's bullish. But if we rally and volume's weak, it tells us the market's divergent. And that was the principle. So markets rallying on strong volume. Let's go. Here we go. You load up and then bam, the market would break. And I often found the times that the market looked the strongest, I'd get the most excited. I would put on the biggest positions. And of course, I had unbelievable attachment to those positions because I had done my work and I had seen that we were in a strong uptrend with super strong volume. And then it'd fall apart and I get knocked out. I'd lose a lot of money. And I get really frustrated by this. So this happened long enough that I said, I'm done with volume. I literally took it off my charts. And I did not use volume at all for probably 15 years. Not at all. So when I was running my asset management firm and we were managing money for clients, I was watching these charts all the time. We had trading systems that we had built. I was monitoring these systems. I was looking at it, and I felt like something was off. And so I decided, you know what? I'm going to go back and I'm going to study volume, but I'm going to do this on my own. I'm not going to go by what anybody said. And I went and I spent about 3 months where we did a whole bunch of testing. I did deep dives on all these different aspects of volume. And in doing so, I found something. I found something I never saw before. And in finding it, I started to be able to answer the question of what volume really, really meant. That when we rallied, sometimes strong volume on a rally was good, and sometimes strong volume on a rally was bad. It was weak. I started to be able to decipher when that was the case. And so I started to get this context around volume which then led to price action that gave me these tools that I never had before. Now, a lot of the way we used to do things was we'd create these zones. And essentially, we'd have these zones that were strong and these zones that were weak. So if we were in an uptrend, we'd have these really strong support zones below the market. We'd have resistance zones above, and they might be weak. So we'd expect them to break. When I say break, the market price would go through them. Resistance would not hold very long. It might hold for a little bit, but not ultimately, it would break down. All right, so we'd have these zones. So market revert into a strong support zone. I'd buy it, and then then I would use excuse me. I would use all these volatility metrics to set where my stop would be. And then what I found in that, and I was a big believer in trying to get big winning trades, even back then. So maybe I could get 3R, but it was very rare that I could find trades that I could get 5, 10, 20R. I could get lots of 3Rs, but I couldn't get the big ones. And I'd have a lot of trades. I'd put them on. I'd buy in the strong support zone. The price would fall. It would stop me out, and then it would V out and go. And I wouldn't be on it. And so here I had an idea, did all the homework on it. I mapped out a zone that I knew would hold, and it ultimately did hold. If I get stopped out by this much, and then I watch it take off and be an amazing trade without me. When I started to understand price action, everything changed because I didn't need to map out some type of volatility stop. I didn't need to guess how far away I needed to have it. I started to have concrete structure that I could hide behind when I put my trade on. And then with the structure that I had, that started changing my R's from 3R to 10R, 15R, 20R. And sometimes I had really small risks. When I did the zones, I had small risks. I was just waiting to get run over. It was stupid to have a small risk. But when I started to understand price action, there's certain patterns that I could see that I could put the trade on, and I knew that if it took out the low, I was wrong. Knew it, even though it was small. So if that was the case, I could lean on that, and that would create a bigger R, and it create a bigger allocation to the trade because I had less risk. I could buy more contracts, or I could buy more shares. So that was enormously helpful in setting up trades, but then it also became incredibly helpful to exit trades and to manage trades. These are charts that have been market leaders over the last 6 months. A lot of you might have positions on in these. Okay, so good example. This is Robinhood. This is a market that was an incredibly good trade. I was on a call with a student, and basically when the market was in here, I was telling him the trade's done. He's like, really? I said, yeah, it's over. It's time to get out. He did. And so this is a classic example. You can start to look at trades like this, and if you're long, you'll know it's over. It's time to get out. Okay. Another one like this. Let's go back because this is one I'll pull up in Reads Report. In our Reads Report that we do every month, go back to last summer. When we had this move right here in NVIDIA, I said this in the Reads Report. I said, this move is done for a long time, maybe for good. The high of this move was 140. You can see that it basically took 5 months to take it out. And it never took it out convincingly. Every time it got up in here, it got rejected. And so this is a good example with a long NVIDIA position. We are able to use this to hedge up the position in a way that we had very little downside if it sold off. Well, it did sell off. And here's another example of a potential bottom. That price action would tell us that this actually might be the place to get long. A trade that we were in recently that got stopped out was in Netflix. Well, Netflix down in here this actually looks like a bottom in Netflix. The price action tells us this. So this is something that we can utilize to get in and get long. All right, we have another one going on today in gold. The price action is telling us that this is a substantial breakout. This is a breakout that's likely to follow through. This is a breakout that I think gold is going to have an extremely strong up leg out of this move. So we have the breakout surrounding we have the price action surrounding the breakout, which is validating the move. The other thing we have down here is we have the price action that validated this as the low. Right here, we know this is a low. So we can be buying it here, or we can be buying it here. Then what's great is, okay, this was on February 28th. We're getting the confirming signal on February 4th. Sorry, March 4th. Well, if we understand price action and we start to understand how market timeframes interact with each other, we saw us getting long on March 4th. Well, we actually have significant price action patterns down in here on Friday the 28th that are putting in a low. And they get confirmed on the opening on the 3rd. Sunday night the 2nd, technically, but the 3rd. So now we have a pattern that if we understand how to utilize this, we're getting long here with a risk point under here, instead of where I just showed you, be getting long over here. It's about half the risk. And how are we able to do this? By reading the price action within this time frame. So let's go a little further into what we're going to go through in this course. This course is a substantial course. You'll be watching before we start. You're going to have modules you need to get through before we start. For some of you, you already know this. It's not a big deal. For some of you, if you're newer, it'll be really helpful. So we're going to basically show you how to identify consolidation zones that have breakout potential. We're going to help you be able to, like we saw in Robinhood, we're going to help you be able to identify exhaustion patterns and trend reversals. So we'll know when tops and bottoms are going in. We're going to teach you how to use candlesticks to confirm and refine your entries. So one of the things we look at is like a single candle. Sometimes it does, but typically it takes a series of candles to be able to confirm a signal. So we're going to show you how to utilize these, how you'll combine price patterns, volume, and structure to be able to create really good entries. So like that example I showed you in gold, that was combining all of these things. It was not just a pattern. It was a pattern, it was volume, and it was structure. We're going to teach you how to analyze volume spikes. We're going to have very simple rules. When you open up a chart, you'll know the very first thing you should do. You go check this and you'll be good to go. So we're going to be able to recognize volume spikes and understand what they mean. We're going to be able to stack multiple confirmation indicators. So why does the gold trade look so good? Because we have alignment on the yearly, on the quarterly, on the monthly, on the weekly, on the daily. All the time frames are lined up. They're all ready to go. You don't see this very often. But when they're all lined up and they're all ready to go, you get big moves. We'll start to understand how to understand where stops go and how volume gets trapped. Volume traps are a big thing that we teach a lot on. Get a bunch of people that buy, where are they trapped? Because when they're trapped, they're going to have to rush for exit, and that creates a big move the other way. We're going to go through how to eliminate emotional trading through the use of price action. We're going to set up our risk reward rules so that we know our risk and we have a clear exit strategy. When we incorporate options, we make it even better. We'll show you how you can backtest these patterns. We're going to focus on execution, not prediction. So if you had this complete framework and you could apply them in these principles in real time, what could you do? Effectively, we're showing you a structured step-by-step process that's designed to help you trade with confidence and precision.